Hi, my name is Matthew Deutsch, and I'm a professional business plan writer. Today I'm going to talk about writing a business plan that will get you the money that you need to start your technology enterprise from a venture capital group or private investors. This video is a little bit more geared towards individuals that are starting e-commerce related businesses, software as a service companies, mobile applications, and sort of related businesses, rather than, let's say, a restaurant or local retail store. With that being said, a lot of the same principles do apply if you're looking to raise money from any type of funding source. If you're a smaller, if you're going to be an entrepreneur that again is starting a restaurant or any other type of related retail store, and if you're not going down the road of looking for an SBA loan or a conventional business loan, I'll have a discussion in this video as well about the sort of the focus that you could have in order to effectively acquire smaller scale investors that do invest in local businesses. But the vast majority of this discussion is going to be centered on people starting technology or larger scale enterprises that do require venture capital or funding from, let's say, a private equity firm. As it relates to writing the business plan and just sort of just a note in general, I always tell clients, when you're looking to raise capital from a venture capital group or private investors, you almost have two types of customers. And the first group of customers you have are your funding sources. And the way that you're going to keep those individuals happy is by showing that the business is going to have continual growth, the value of the business is going to continue to increase, and that ultimately in a 3 to 5 to 7 year period, that you'll be able to effectively sell that business to a third party for a substantial profit. That's going to be the primary concern of any venture capital group. In regards to, let's say, dividends, the vast majority of venture capitalists do not need dividends and would rather see that money reinvested in its entirety back into the business in order to get that higher return on investment, especially once you achieve profitability and the business model has been proven. They're going to want to plow all that cash back in, especially into expanded marketing campaigns to onboard a greater number of customers, especially for software as a service businesses that produce recurring income. That's going to be their primary focus. If you're, again, going after capital to start your own restaurant, I'm going to use that example throughout this video, they're going to want to see more short-term returns on their investment. Primarily because if you're looking to raise capital from an investor for, let's say, a restaurant, you're not going to a venture capital firm. They do not finance those types of businesses. Most venture capital firms, typically even moderate scale ones, have a minimum investment of anywhere from $5 to $10 million. Smaller scale ones, $1 to $5 million and $10 million for their larger deals. And for huge investment groups, they're not touching anything under $25 to even $100 million. So, you have to sort of plan to know your audience and should write the business plan accordingly to make sure that when you're selling the business to a potential funding source, you're speaking the language of what they want to hear in terms of their investment profile and their perspective for engaging in investment. Going back to sort of the technology enterprise, one of the key focuses of the business plan should always be on valuation again. That's going to be their huge concern because venture capital groups take money from wealthy individuals and corporations looking to maximize their returns on investment, and their job in order to get their 20% is to make sure that they deliver well above market rate returns to their investment group. So keeping that in mind when you're writing a business plan specific for any type of technology enterprise, that's absolutely going to be one of the things that you want to highlight in the plan. Beyond that, one of the things I see, and I don't want to call it a mistake, but a lot of people just sort of go in this direction, is that throughout the business plan, especially if it's geared towards venture capital, is that they focus very heavily on the product and service that's being offered. And that is still extremely important. You're going to absolutely want to explain to any potential funding source why your product is great, why your service is great, why people are going to want to use it, why people will continue to buy it, let's say even in a challenging economic climate. All of those things need to be very carefully discussed within the plan to show why this is going to be something that's economically viable. One of the things I don't want to call it a mistake, is that when they take that approach, you forget the fact that when you're working with a venture capital group, you're not selling them on the product and service. Certainly they want to see what you're doing and make sure that it's going to be good, but what you're selling them on is the business. And that's really the key crux of the business plan, especially when approaching a venture capital group or any other type of private funding source, is that you want to make sure that they understand that the money that they're putting into this enterprise is going to yield a very large return in the long run, because that's ultimately what you're selling. You're selling a percentage of your business to the investment group. And you can almost view the business plan as a marketing tool to raise that capital. Similarly, when you have your marketing campaigns for selling your product or service, you'll have search engine optimization, targeted social media, traditional advertising, social media influencers. That's the way you're selling your product and service. For your investor, the way you're selling your company is through a business plan and a pitch deck. One of the things I always tend to do is that you almost want to take a certain clinically focused approach and almost like a scientifically focused approach as to why this is an economically viable investment. And again, showing, if you're a software as a service business, absolutely focus very heavily on the recurring streams of revenue that you're generating. Same deal for if you're a mobile application, if you're going to have in-app purchases, or if it's a subscription-based product, focusing very heavily on that recurring revenue that will ultimately compound over time, will allow for ongoing reinvestment of your profit into continually expanding the business. All those things are going to, you're sort of hitting the right buttons with any sort of venture capital group, especially if your service is going to be recurring in nature. That's something that they're always going to want to see. That's something that they love, and that's something that should be absolutely highlighted throughout the entirety of the business plan. Returning again, just very briefly, and I apologize if if I go around a little bit, but I always like to just hone in on these points. Alternatively, if you're working with a smaller group of investors to start a more traditional business, again, focus a little bit more heavily on dividends. I'm starting this restaurant. Here's the cuisine I'm selling. Here's what our revenues are probably going to be. Here's what our expenses are, and here's our profit. And of that profit, X percentage of it will be kept as retained earnings just to make sure we have a nice financial cushion. And the other percentage of it will be provided to investors as their return on investment. For things like a restaurant, you're not necessarily going to sell that business right away. That could be a restaurant that's run for the next 20 years. So anyone that's putting up capital to start that business may have to understand that this capital is going to be locked in and that you're just going to enjoy a highly predictable stream of revenue until it's ultimately sold at some point in the future. Conversely, venture capital firms always want a very clear exit strategy over a 3-year period, 5-year period, 7-year period for valuation, but they want to make sure that they're going to be able to recognize an immense return, again, within a maximum time frame of 7 years. Very infrequently, it'll go a little bit longer than that, but typically not, because again, they aggregate those funds from wealthy people, corporations, endowments, trusts, and they want to see that very large return. Again, I don't want to say quickly, but certainly within a 3 to 7 year period. And that's always something that you should keep in mind when you're developing that type of business plan. That's going to be pretty much it for this video. Certainly, I know we covered, a little bit of ground here. If you have any questions, put them in the comments. Also, part of this video series is to promote my own business. Again, I've been writing business plans extensively for the past 19 years. It'll be 20 years this September. If you're struggling with your business plan, or if you need help with anything related to it, or just want a consultation, please feel free to visit the link below. It'll take you right to my website. You can view samples of both business plans and pitch decks across the entire spectrum. We have a few samples on there for e-commerce related businesses, software as a service businesses, as well as traditional businesses such as real estate related activities, restaurants, medical service businesses. So feel free to take a look, and if you have any questions, absolutely feel free to give us a call at any time. And thank you again. Take care.